Jessica Monroe had worked as a bank examiner for the Federal Deposit Insurance Corporation for 11 years. At 36, she was a senior compliance officer specializing in fair lending investigations. Her job was to ensure banks followed federal laws prohibiting discrimination in lending based on race, gender, national origin, or other protected characteristics. Fair lending discrimination was often subtle and difficult to prove. Banks rarely explicitly denied loans based on race. Instead, they used pretexts, questioning business plans more aggressively for minority applicants, applying stricter standards for creditworthiness, requiring additional documentation not requested from white applicants, or simply denying loans based on subjective assessments of the borrower's character or business viability. To catch these discriminatory practices, the FDIC conducted paired testing operations. Examiners would pose as loan applicants with carefully matched financial profiles and observe whether banks treated them differently based on race or other protected characteristics. Jessica had been assigned to investigate Riverside Bank, a regional institution with 14 branches across Washington state. The FDIC had received 17 complaints over 3 years from minority borrowers alleging discriminatory loan denials. The complaints described a pattern: minority applicants with strong credit and solid business plans being denied loans that seemed comparable to those approved for white applicants. Riverside Bank's lending data also showed disparities. Black applicants were denied small business loans at rates nearly 3 times higher than white applicants with similar credit profiles. Latino applicants faced denial rates twice as high as comparable white applicants. These statistical patterns warranted investigation, but statistics alone weren't enough to prove intentional discrimination. The FDIC needed documentation of disparate treatment in specific cases. That's where Jessica came in. She would apply for a small business loan at Riverside Bank's Seattle branch using her real identity, but presenting herself as a regular applicant rather than a federal examiner. A white male colleague with an identical financial profile would apply separately. If the bank treated them differently, that would provide direct evidence of discrimination. Jessica had spent 2 weeks creating a complete small business loan application. She'd developed a detailed business plan for a graphic design consultancy, assembled 3 years of tax returns showing steady income as a freelance designer, obtained a business credit report showing excellent credit, and prepared all documentation a legitimate applicant would provide. Her application requested $50,000 for equipment, software, and working capital to expand her freelance business into a full consultancy with employees. The loan amount was deliberately modest and well within her demonstrated ability to repay based on her income and credit history. On paper, Jessica was an ideal borrower: stable income, excellent credit score of 742, low debt-to-income ratio, detailed business plan with realistic financial projections, and personal assets that could serve as collateral if needed. On a Wednesday morning at 10:15, Jessica walked into Riverside Bank's downtown Seattle branch. She wore professional business attire and carried a leather briefcase containing all her application materials. She approached the reception desk and asked to speak with someone about a small business loan. The receptionist directed her to Robert Hamilton, the branch manager, whose office was visible through glass walls at the back of the branch. Hamilton was in his early 50s, wearing an expensive suit that signaled his position. He looked up from his computer as Jessica approached, and his expression shifted subtly from neutral to skeptical. "Good morning, I'm Jessica Monroe. I'd like to apply for a small business loan." Hamilton stood and shook her hand with minimal warmth. "Robert Hamilton, branch manager. Please have a seat. What type of business are you looking to finance?" Jessica sat and pulled out her business plan. "I'm a freelance graphic designer looking to expand into a full consultancy. I need $50,000 for equipment, software licenses, and working capital to hire 2 employees." Hamilton took the business plan, but barely glanced at it before setting it aside. $50,000, that's a significant amount for a startup. It's not a startup. I've been operating as a sole proprietor for 6 years. This loan would finance expansion of an existing profitable business. Freelance work is unstable income. Banks consider that high risk for lending purposes. My tax returns show consistent income averaging $85,000 annually for the past 3 years. That's stable and sufficient to service a $50,000 loan. Hamilton's skepticism didn't ease. "Tax returns can be optimized. What's your actual cash flow month to month?" The question was reasonable for any loan application, but Hamilton's tone suggested he doubted Jessica's financial representations. She pulled out detailed financial statements. Here are my business bank statements for the past 2 years, showing monthly deposits and expenses. My cash flow is positive every month, with an average of $6,000 in monthly net income. Hamilton took the statements and reviewed them with obvious suspicion, as if searching for evidence of fraud rather than assessing a legitimate application. Who are your clients? I work with small businesses and non-profits on branding, marketing materials, and web design. My client list is in the business plan with references from long-term clients. Small businesses and non-profits. Those aren't the most financially stable client base. They're stable enough that I've maintained consistent revenue for 6 years. The business plan includes diversification strategy to add corporate clients. Hamilton set down the financial statements. Miss Monroe, I'm going to be direct with you. Small business lending is complex and risky. Banks need to be careful about who we lend to, especially in creative fields where success is unpredictable. My success isn't unpredictable. I have 6 years of profitable operations and detailed projections showing how the loan will generate additional revenue. Projections are just estimates. They don't guarantee repayment ability. No projections guarantee anything, but mine are based on conservative assumptions about client acquisition and realistic pricing based on market research. Hamilton leaned back in his chair. Let me ask you something. Have you considered that 50,000 might be too ambitious? Perhaps you should start smaller. Maybe consider a personal loan or a business credit card to test the expansion before taking on significant debt. Jessica recognized this tactic from fair lending training. Steering minority applicants towards smaller amounts or different products rather than the loan they'd actually requested was a common form of discrimination. I've considered my financing needs carefully. I need 50,000 to execute my business plan properly. A smaller amount wouldn't allow me to hire staff or purchase necessary equipment. I'm just trying to help you avoid overextending yourself financially. A lot of people in your situation take on debt they can't manage. My situation meaning what exactly? Hamilton realized he'd said something problematic. I mean people expanding from freelance to business ownership. It's a big transition. I'm aware of the transition requirements. That's why I've prepared a comprehensive business plan, assembled complete financial documentation, and applied for an appropriate loan amount. What specifically concerns you about my application? I haven't seen your credit report yet. What's your credit score? 742. The credit report is in my application packet. Hamilton pulled out the credit report and scanned it. Finding no problems there, he shifted to another objection. Do you have collateral? I have 15,000 in business savings, and I own my car outright, valued at approximately 22,000. I'm willing to provide personal guarantee and collateral as needed. Hamilton was running out of obvious objections, but his resistance to the loan remained clear. Miss Monroe, lending decisions aren't just about numbers. They're about overall assessment of risk and likelihood of success. Graphic design is an extremely competitive field. Your business plan, while detailed, doesn't convince me that expansion is viable. Can you specify what's unconvincing about the business plan? I'd be happy to address any concerns. It's not any single element. It's an overall impression that this expansion is premature and risky. Jessica pulled out a notepad. I'd like to document your specific concerns for the record. You're saying that despite 6 years of profitable operation, excellent credit, stable income, and detailed business planning, you believe the loan is too risky based on your impression. Hamilton's expression shifted to defensive. I'm explaining standard lending criteria. If you're not satisfied with my assessment, you're welcome to apply at other banks. I'd prefer to complete this application here. Is there additional documentation I can provide to address your concerns? I don't think additional documentation will change the fundamental risk profile, so you're denying the application. I'm suggesting you reconsider the amount and timing. As I said, perhaps start with a smaller personal loan. I'm not asking for suggestions. I'm asking if you're denying my small business loan application for $50,000. Hamilton stood, signaling the meeting was over. I'll need to review your complete application and consult with our underwriting department. The process typically takes 2 to 3 weeks. We'll contact you with a decision. Jessica knew this was another delaying tactic. Hamilton had essentially decided to deny the loan, but wanted to avoid an immediate documented denial. By claiming he needed to review further, he could deny later with written justification that would be carefully crafted to avoid obvious discrimination. I'd like to complete the formal application now and receive a timeline for decision. You can complete the application with our loan officer. I've given you my initial assessment. Jessica left Hamilton's office and completed the formal loan application with a junior loan officer who seemed uncomfortable, suggesting she'd overheard the conversation with Hamilton. 2 weeks later, Jessica received a letter from Riverside Bank denying her loan application. The denial letter cited several reasons: insufficient business history despite 6 years of operation, questionable stability of income despite consistent tax returns, concerns about market saturation in graphic design, and determination that the business plan didn't demonstrate adequate likelihood of success. Every reason was subjective and contradicted by the objective evidence in Jessica's application. The denial letter was exactly what fair lending investigators looked for: pretextual justifications that appeared facially neutral but actually reflected discriminatory decision-making. 3 weeks after Jessica's denial, her white male colleague applied to the same Riverside Bank branch with an identical financial profile. His business was graphic design consulting. His income, credit score, loan amount, business plan structure, and financial documentation were all matched to Jessica's application. The only differences were his race, gender, and name. Everything else was statistically identical. Robert Hamilton personally handled his application. The meeting was recorded with the applicant's consent using a hidden camera, legal under Washington state's two-party consent law, since one party to the conversation was recording. Hamilton's treatment of the white male applicant was dramatically different. He greeted him warmly, expressed enthusiasm about his business plan, noted that graphic design was a growing field with excellent opportunities, praised his financial discipline as shown in tax returns and bank statements, and approved his loan application subject to standard underwriting review within 45 minutes. The applicant received loan approval 1 week later with terms identical to what Jessica had requested. The disparate treatment was undeniable and documented. Jessica and her colleague had presented identical applications to the same bank manager. She was questioned aggressively, steered toward smaller loan products, told her business plan was unconvincing, and ultimately denied. He was welcomed, encouraged, praised, and approved. The only variable was race and gender. Jessica compiled her findings into a comprehensive investigation report. She documented Hamilton's questioning of her income stability, his suggestion that her business plan was inadequate, his recommendation to seek smaller loans, and his ultimate denial. She contrasted this with Hamilton's enthusiastic approval of the identically qualified white male applicant. She also reviewed Riverside Bank's broader lending data. Over 3 years, the bank had denied small business loans to 47% of black applicants and 39% of Latino applicants, compared to 17% of white applicants. When controlling for credit scores, income, and loan amounts, the disparities persisted, suggesting the differences weren't explained by objective financial factors. Jessica's report concluded that Riverside Bank engaged in systematic discrimination in small business lending, with particularly severe disparities for black applicants. The discrimination violated the Equal Credit Opportunity Act, the Fair Housing Act as applied to commercial lending, and multiple federal banking regulations. The FDIC's Enforcement Division reviewed Jessica's findings and initiated formal action against Riverside Bank. The enforcement action included several components. First, the FDIC issued a cease and desist order requiring Riverside Bank to immediately stop discriminatory lending practices and implement comprehensive fair lending compliance programs, including mandatory training for all lending staff, standardized objective lending criteria, and regular auditing of loan decisions for disparate treatment. Second, the FDIC imposed a civil penalty of $2.7 million for violations of federal fair lending law. Third, the FDIC required Riverside Bank to establish a $3 million remediation fund to compensate borrowers who'd been discriminated against, including reviewing all denied minority applications from the past 5 years and offering loans to qualified applicants who'd been wrongly denied. Fourth, and most significantly, the FDIC placed Riverside Bank under enhanced supervision, meaning federal examiners would conduct quarterly reviews of all bank operations with authority to impose additional sanctions for any compliance failures. The enforcement action was made public as required by federal banking law. Local and national media covered the story extensively. Headlines focused on the dramatic testing evidence. Federal examiner denied loan by bank she was investigating, and identical loan applications, opposite results. FDIC finds systematic discrimination at Seattle Bank. The publicity was devastating for Riverside Bank. Within weeks, community organizations called for boycotts. Several large commercial clients moved their accounts to other banks. Minority business groups filed additional complaints with regulators about past loan denials. The bank's board of directors held an emergency meeting and terminated Robert Hamilton's employment. They also forced out the bank's president, who had failed to establish adequate fair lending oversight despite knowing about complaint patterns. But the damage was done. Riverside Bank's reputation was destroyed. Deposits declined by 38% in 3 months as customers fled. The bank's stock price collapsed.
Credit rating agencies downgraded the bank's debt, making it more expensive to borrow funds needed for operations. 6 months after the FDIC's enforcement action, Riverside Bank's board voted to sell the institution to a larger regional bank rather than continue operating independently. The sale price was significantly below the bank's value before the discrimination scandal, costing shareholders millions in losses. The acquiring bank immediately closed 3 Riverside branches, laid off more than 60 employees, and completely restructured lending operations under new management committed to fair lending compliance. Robert Hamilton's banking career was over. No other financial institution would hire a branch manager with a documented record of discrimination that had contributed to his bank's collapse. He eventually left the banking industry and found work in insurance sales. Jessica continued her work as a federal banking examiner, using the Riverside Bank case as a training example for other examiners. The case demonstrated how paired testing could provide irrefutable evidence of discrimination and how discriminatory lending practices could destroy a bank's viability. 2 years after the investigation, Jessica was promoted to senior examiner, supervising fair lending investigations across the Pacific Northwest region. She implemented systematic paired testing at banks with suspicious lending patterns, resulting in several additional enforcement actions against discriminatory lenders. The Riverside Bank case also influenced federal banking policy. The FDIC revised its examination procedures to include more frequent fair lending testing and created stronger penalties for institutions with proven discrimination. The case was cited in congressional testimony about the need for vigorous enforcement of fair lending laws. 5 years after her denied loan application, Jessica spoke at a banking industry conference about fair lending compliance. She shared her experience at Riverside Bank without identifying herself as the applicant, describing it as a case study. A bank manager saw a black woman requesting a $50,000 small business loan and immediately assumed she wasn't creditworthy. He questioned her income, despite tax returns showing stable earnings. He criticized her business plan, despite it being detailed and realistic. He suggested she wasn't ready for business ownership, despite 6 years of profitable operation, and he ultimately denied her loan based on subjective impressions rather than objective financial criteria. That same bank manager met with a white male applicant with identical financial qualifications 3 weeks later and approved his loan enthusiastically within days. The only difference between these applicants was race and gender. Everything else was statistically matched. Jessica continued. The bank manager didn't think he was discriminating. He probably believed he was making sound risk assessments, but his assessment of risk was shaped by racial bias that made him see a qualified black woman as suspicious and untrustworthy, while seeing an identically qualified white man as promising and reliable. That bias cost his bank its independence, cost shareholders millions of dollars, cost dozens of employees their jobs, and cost him his career. Discrimination isn't just morally wrong and legally prohibited, it's catastrophically bad business. The speech resonated throughout the banking industry. Several major banks used Jessica's presentation in their internal fair lending training programs. Banking trade associations invited her to develop compliance guidelines. 10 years after the Riverside Bank investigation, Jessica had risen to Assistant Regional Director for the FDIC, overseeing all bank examinations in a 5-state region. She'd conducted or supervised more than 40 fair lending investigations, resulting in 33 enforcement actions and over $70 million in penalties and restitution to discriminated borrowers. The Riverside Bank case remained her most prominent success, both because of the clear evidence of discrimination and because of its industry impact in demonstrating the severe consequences of discriminatory lending. Robert Hamilton gave one interview about the case years later, speaking with a banking ethics publication about lessons learned. His reflection seemed genuine, though it came too late to save his career or his bank. When Jessica Monroe sat in my office requesting a business loan, I saw a young black woman and made assumptions. I assumed her income wasn't as stable as her tax returns indicated. I assumed her business plan wasn't as solid as it appeared. I assumed she was overreaching and would likely default. Those assumptions weren't based on evidence. They were based on racial stereotypes about black people and business capability. 3 weeks later, I met with a white man with the exact same financial profile, and I had completely different assumptions. I assumed his income was reliable. I assumed his business plan was sound. I assumed he was a good credit risk. I approved his loan without hesitation. The difference in my treatment wasn't based on their actual qualifications. It was based on their race. Hamilton continued. I destroyed my career, destroyed my bank, and harmed countless borrowers who deserved fair consideration of their loan applications. And I did it because I never examined my own biases about who was creditworthy and who wasn't. Jessica Monroe turned out to be a federal banking examiner investigating discrimination, and my discriminatory treatment of her application gave regulators the evidence they needed to take down Riverside Bank. But even if she hadn't been an examiner, what I did to her was wrong. She was qualified. She deserved approval. I denied her because of her race. That's textbook discrimination. The Riverside Bank story became a legendary cautionary tale in banking. The branch manager, who discriminated against a federal examiner investigating discrimination. It was taught in banking schools, compliance training programs, and fair lending courses as an example of how discrimination could be documented and how severely it would be punished. And across the banking industry, lenders learned that any applicant could potentially be a federal examiner conducting a fair lending test. That uncertainty created an incentive to treat all applicants fairly, since discriminating against the wrong person could mean career-ending consequences and institutional collapse. Jessica Monroe had walked into Riverside Bank as a qualified loan applicant and been denied based on racial discrimination. She'd also walked in as a federal banking regulator with authority to investigate and sanction discriminatory lenders. Robert Hamilton saw a black woman he could dismiss. He didn't see the federal examiner who would document his discrimination and trigger the enforcement action that would destroy his bank. That was the cost of discrimination in banking, not just violating federal law and harming individual borrowers, but potentially devastating entire institutions when the person discriminated against had the power to demand accountability and impose consequences that no bank could survive.
Thank you very much for listening. Please let us know what you think of this story in the comments. Don't forget to like the video and subscribe to the channel. Turn on notifications so you don't miss any other videos.